is regarding kind of the overseas market and how it pertains to us here. So we got a graph up here regarding the market speculation and the prices we've seen. Can you talk a bit about the trend that we've witnessed overseas and its impact on us here thus far?
Well, when you look at the first half of the year, I mean, there were two things that were really driving this market. One was, the relatively low inventory levels or perceived low inventory levels. And the second was just outright market speculation tied to the situation in Europe. And there's going to be more slides that are going to address this point in more detail. But the fact of the matter is that while we are connected to Europe with 14 BCF of LNG export capacity, the natural gas market in North America is still independent. So, you can talk about $1,000 price in Europe or $100, as the chart shows here, but all that really is Europe trying to outbid Asia for cargoes that are already loaded on ships. It doesn't change how much gas is leaving the U.S. because we've been consistently at or near capacity on our LNG export capacity.
So when someone says, I was in a meeting recently where they're like, we are tied at the hip to Europe and its prices, your answer is no.
Fundamentally, no.
Fundamentally, no, we're not.
No. And you saw the impact of speculation back in June when the Freeport LNG facility had a fire that reduced our export capacity by 2 billion cubic feet a day. Gas dropped $4.
Yeah. So
that's telling you, how much people are weighing in on the LNG and how much we're tied to Europe.
Yeah. The conflict overseas has had an impact on our market. There's no question about it.
Well, it's had an impact on all commodity markets.
Right.
And it's really opened all of the markets up to an extremely high level of speculation. I think as we'll note with the next slide.
Well, I was just going to say here.
I think as we note with the next slide.
So the next slide. So here's this picture here that you guys are looking at is the profit from our friends in the hedge fund sector.
That's right.
Regarding commodities exclusively. And why don't you talk about this? Because last winter, you guys all bear witness to this. If you hedged, you didn't have to deal with this as much. We saw run-ups of $1 plus in the last hour or two before our close. What the heck is going on over there? And could it happen again?
Well, since nobody took any action, CFTC never did anything about it. Yeah, it could happen again. It's amazing though, because these are considered oil and natural gas are two of the most liquid commodities markets in the world. And the fact that someone could drive a market over $1.50 in the last half hour of trading was just stunning. But still, there's been no explanation from the CFTC or any of the regulatory authorities. But we saw this consistently, where as you approach the expiration of the futures contracts, which are 3 business days prior to the start of the month, that we consistently had these big run-ups.
Well,
and that was one of the things that, I have to admit, initially it caught us off guard, that just the size of these moves and the apparent funds going into these markets, which, generated our advice in June to go ahead and hedge the next 3 months.
Yeah. Well, do you have I hate to use the word fear, but do you have a feeling, could this happen again this winter? I mean, we're staying focused on the next 5 months, but
well, we are moving into a different economic window now, with, increased chances of recession with the way the commodities have been changing. But, one thing you have to understand is these big hedge funds often drive the narratives. So, even though our inventory levels were still within normal range, if you will, although on the low side, I mean, there was this narrative that, oh my God, we're not going to have gas for winter. We're going to be in crisis. And of course, we rejected that narrative, which is why we limited our summer hedging to 3 months, because now here we are in fall and we got a lot of gas. And our inventory, while it's still low, is filling up pretty rapidly now.
Yeah, right.
Prices have cratered.
So let's shift gears from kind of the market speculation and just a quick hit of the past. and go to the next slide, which is liquefied natural gas and its exports. In brief, can you explain what the heck is LNG again? And where are we at as a country when it comes to exporting this?
Well, liquefied natural gas, LNG, is the way that you transport natural gas overseas. Here in the country, it stays in a gaseous state. We transport it through large diameter pipelines and eventually into distribution lines. But in order for it to go overseas, you have to liquefy it. Mm-hmm. And so you do a deep freeze, minus 400 degrees, liquefy it, stick it on tankers, send it overseas. And that's how we export natural gas. Most of our exports have actually been bought by the Chinese. The Chinese were willing to do long-term contracts a number of years ago because it takes 4 to 5 years to build these facilities. So they put a lot of money into the current tranche of LNG plants. And right now, our capacity is about 14 billion cubic feet a day, or about 15% of U.S. production. And we've been tagged at that level. You're not going to see another increase. I mean, so we built 14 BCF of capacity, and then everything kind of hit a plateau. But now the Europeans, for the first time, now that they've figured out that Russian natural gas may not be a great idea, the Europeans now are signing long-term contracts. So there's another tranche of new LNG facilities will be coming, but at the earliest in 4 years.
Okay.
These are very expensive, very complex plants that take years to build.
Okay, and so, and in brief again, my goal is to answer, ask simple questions. Exactly, ask simple questions. So here's what a layperson would say. The market is tenfold in Europe right now. Well, clearly businesses are just going to liquefy and ship it to Europe to solve the problem there. And your response is?
Our capacity to do that is limited.
Okay. We're booked out, right?
We're booked out. Good phrase.
So, and the reason I'm and you know this, Blake, the reason I'm asking this is because I think that's a common narrative right now is like LNG is a hot button topic. It's extremely important, but we're tapped out here. Like we just can't come to the rescue. And as you pointed out earlier, you don't whip up a plan. And we said this before, multi-year approach. I did put one slide in here for the fun of it. Tell me about the activity in brief going forward. Is our country pushing more LNG, or are we going to flatline? What's the long-term view of this?
Well, when you say country, and this is where I get frustrated sometimes because these are businesses making business decisions. The U.S. government does not control our LNG and LNG investment decisions. As I said before, Europe was totally focused on Russian energy supplies. And the only time they bought LNG was when they bought a spot cargo. It was actually the Chinese. In fact, you look at Russian disinformation right now, they're like, oh, the United States is making all this profit off of, the pain in Europe. The reality is China is making all this huge profit because China is the one that invested in these plants and pre-bought these cargoes at market rates. Yeah. So the Chinese are now selling the LNG to Europe, and they're fuel switching to coal and other energy sources that they still have in China.
So last question on this, and we're going to switch gears then is, does LNG have if someone's listening to this right now, does it have an impact for this winter that you can see a direct narrative?
The only wild card for this winter is the fact, we alluded earlier to the Freeport LNG facility having a fire last June. That facility has still not come back online. And there's still speculation as to when it will come back online. So if it comes back online in November, it's going to be supportive of price. If it doesn't come back until January, as we were talking the other day, that's actually penultimate winter. And the chances are if it comes back in January, unless it's a really bad January, it's not going to have that much of an impact. So, yeah, but that's really a mild wild card, especially when you compare to weather. Weather is always the big dog in winter.
Well, we'll get there.
Yes, we will.
Next, natural gas production and storage. So here's a image that I don't want people to put too much energy on about storage. Once again, for a layperson, where's gas stored for winter? Like, I don't understand. Doesn't it just come through a pipeline to me?
Well, gas is stored in two different types of formations. One is a depleted reservoir where there was gas, and they're now using that field to store gas. You see that in Illinois. Northern Illinois Gas has over 200 BCF of in-ground storage. And you see it a lot in Louisiana and Texas and scattered in other places around the country. The other kind of storage is your salt dome storage, which you predominantly find in the South, like Hattiesburg, where there's a salt formation. They basically put water in, created brine, pulled the brine out. And so they actually created a giant vacuum bottle in the ground. And that provides, a smaller level of storage, but very high deliverability. And deliverability is important in winter, and it's important to power plants.
All right. So the follow-up question is, why is everybody watching us so closely right now? Why is it so important for us here in Wisconsin when it comes to the winter price?
Well, inventories are considered to be one of the components of, judging the winter. I mean, right now we're on track we really are on track. I mean, if you look at the charts we've been sending out, it's been tracking along the low limit, if you will. But you'll see in the last 2 weeks, as the weather's moderated and we're getting record production, you're seeing that curve starting to come into play that we've been expecting. That's going to take us up near average before winter gets here.
So along that line, you just kind of alluded to it, but the storage build is super critical this time of year. We were lagging way behind the average. We were a fair amount behind. It was concerning. But the last 2 weeks have done what? And what's the projection over the next 3-4 weeks when it comes to these injections in the ground?
Well, I mean, I'd mentioned before that, we were looking at about 800 BCF over September, October. And the first 2 injections of 103 are confirming that. So we're on track now to put a respectable amount of gas, near average amount of gas into storage for winter. But this still comes back to, what are the funds saying? And they often control the narrative in the press that, earlier in the year it was doom and gloom. We're not going to have enough gas to go through winter. Well, that narrative is disappearing by the day, if you will. But, we'll probably talk about it when we talk about weather, but they can spin more narratives that will impact the market, despite what we're seeing in the fundamental and physical market.
Well, in brief, what's this hurricane done to either? I mean, I'm not trying to be. Well, I feel bad about what people went through, but when it comes to gas exclusively, has it been a good thing? Let's talk like that. I mean,
well, I don't know. I want to say good thing, but if you look at supply and demand,
sure.
The producers of offshore natural gas actually were conservative, and they shut in about 200 million a day of production. But Florida has had a traumatic situation where they've lost power, and a single gas plant, and they have many of them in Florida, but a single gas plant will burn 200 million a day. So the supply demand effect of the hurricane is we lost very little supply, but they've lost quite a bit of demand.
Yeah. And we were expecting a large injection next week.
We were already expecting a large injection.
So there's these bearish indicators out there. So the last thing on this before we shift gears is the slide in front of us, natural gas production. And why don't you explain what's gone on here the last year and where do we see it going?
Well, as we expected, high prices generate more production. Drilling companies go out and drill when prices are high, and that's exactly what we've seen. And this chart's a little bit misleading because it's an averages 7-day average, but in fact, in the last week, we've actually seen daily scrapes that have us actually producing 100 BCF a day. And part of the takeaway of this is that the production we see now is invariably less than what we're going to see in winter, because what we see in summer with pipelines is they're still doing maintenance. Everyone does everything they can possibly do to make the system reliable and ready for winter. So the number of pipes are still in maintenance mode. So maintenance mode holds down the amount of production coming to market. So, but as you get in the winter, everything gets turned on, production jumps up some more. So we're seeing dailies at 100 BCF a day now, which is a record level. We're liable to see even higher come this winter. So we know production is trending very positively in terms of impacting the price the way we want it to go.
I once heard a really wise man say the cure for high prices is high prices.
That's
Do you
right.
agree with this wise person?
I think it was me.
Yeah.
Although there have been many traders before me that said the same thing.
Yeah, no kidding. All right, we're going to shift over to weather, and I want to be very pointed on this with the weather because I went through an hour session down in Chicago where this very intelligent guy talked about for weather for an hour, And after an hour, I could not decipher a gosh dang thing of what he thought was going to come in the next 3 months. So I left frustrated. So I don't want people to be frustrated here. So let's start with a softball. We going to do another La Nina? Is this the third in a row? And what the heck is
this? This is only the second time. I believe it's the second time in since we've been keeping track of weather that we're going to have a third straight La Nina. So, if you looked at some of our information last year, it's clear that weather patterns have been changing. Because if you go back to look at La Ninas in the 1940s and 1950s, they were pretty darn predictable that it was going to be exactly the pattern you're seeing on the screen right now. But in the last 20 years, as things have gotten warmer, I dare say global warming, that pattern has tended to not be as solid. I mean, we've had some really cold La Nina winters, and then we've had some really mild La Nina weathers. And then we get into the whole conversation. This is where you can really blank people, even I sometimes stare, because then you get into what's happening in the Arctic with warming and how we're getting a much more or much less predictable Arctic oscillation, which results in these cold shots coming down.
Well, from the last 2 years, if it's anything to say about this year, I mean, it's a Game of Thrones, winter's coming, and what we've seen is it's delayed out and it's a little more sustained at the back end. And so we've kind of got a viewpoint where, okay, this is what we got to plan and predict for. And we're going to talk about this at the end about the hedging on this. But let's shift gears.
Yeah, let's look at the NOAA charts.
Well, let's look at the NOAA charts here. So you got it in front of you. The next 2 weeks as a country.
Yeah, it's mild. We're expecting big injections.
Okay. And so when we look further out, I mean, that's kind of something we send out in our weeklies. People are keen to. And of course, if you go outside over this week in Wisconsin, that's a determination for the country. It's going to be nice out.
Right.
So this graph in front of people here is seasonal, October, November, December. Now explain this in brief too, of like, what is NOAA seeing at this point in time?
Well, the 3-month charts can be tricky. I mean, the 3-month chart is basically saying that most of the country is going to see above normal temperatures. But this can be a little bit tricky because, what does December really look like? And part of the question about what are prices going to do this winter comes back to, gee, what's December going to do? Because early cold, and as I've said before, we're going to go into winter with about average storage. But December becomes critical because if you get cold weather in December and you start pulling out 100 BCF volumes per week in December, prices are going to likely go back up, right? If December is warm and, we're not pulling out of storage, so effectively storage is, the use of storage is being delayed, then that's going to be bearish and going to be a strong push prices down. It's going to be, go to the next slide, because the big question comes again, when does winter onset this year? Because now we look at December, January, February, and we're seeing a much stronger cold pattern, the probability of a cold pattern. And then you feed that into more and more data that we're seeing on the Arctic oscillation, with the warmer Arctic breaking down the air patterns in the winter, which are tending to put more cold air shots kind of randomly down. And I think both of our eyes glazed over a couple of days ago when we were reading detail on snowfall in Siberia, which is already at high levels this year.
And for everybody's sanity, we're going to avoid that. But
when we were out walking the dogs the other day, there was a particularly woolly critter crawling along a tree there.
Well, as we bridge to the last part regarding winter hedging, I mean, to kind of put it one way, like so far, when we look at a lot of bearish tendencies, the things we just covered, a big one being weather, from what we know today, and Lord only knows, anybody listening to this knows probably as much as we do on the near-term forecast. It's looking good, but that can change. So there's kind of the mindset of like, boy, we'd like to do something, but be careful with you said December to like, oh, we'll just keep riding the wave out here. Like,
it's not only a question of whether the predictions change. We go back again to the whole question of funds and the way they can control the narrative. It's not uncommon for us to see a dip in prices like we're seeing right now. But what can happen, and what has happened historically, is all of a sudden you start getting a narrative about a really cold winter. And people start buying into the really cold winter. And all of a sudden, boom, again, the press becomes kind of an echo chamber. It's going to be a cold winter, and boom, prices are taking off again. So, this goes back to our discussion about, we need to do a 50% hedge here, probably in the near term, and then kind of follow the facts, follow the fundamentals. But seriously think about doing a full 100% hedge before we actually get to winter.
Okay. So, spoiler alert, you just stole my, stole where I was heading with this. So it's like, I'm listening to this and I've been pounding on this too. It's like, God, I hate it when it's just people can't get to the point of what they're telling you to do. So make it very crystal clear here. I mean, what do you want people to do? What permission do we want from people
Well, I'm going to tell you what I'm doing. First off, I'm going to Europe.
Yeah. Okay.
But Josh and I have had extension conversations about this. And basically, I've told him to look at October 10th and evaluate that. What is likely to happen is NOAA updates their winter forecast mid-October. And if the funds do what I think the funds are liable to do, and what we're susceptible to, because we're not going in with 4 TCF in the ground, we're going in with average in ground. So I'm really concerned about this narrative that it's going to be a bad winter and all of a sudden prices take off on us again. So I really think within, and you and I have talked about October 10th as being kind of really, drill down and take a look at this. And that's kind of when we're looking at possibly doing the 50%. Of course, I say that, and we've said those things in the past, and then the market does something, the next few days, and it's like, well,
the kind of take us.
And that's why, we come back to, we need authorizations, because what some of our customers have seen, even this summer, gas got down to 705. We have to wait on authorization to do something, and by the time the authorization comes, market's back at 735. So
So to summarize this, we believe strongly that a hedge needs to be put in place. We don't know quite the timing, but we're looking over the next couple of weeks. We'd like permission looking at November through October of next year to 50%. But we're not so sold out like, we better nail down November. It's really these critical months of December, January, February, and March with this possible delay. We've got to layer something in. It'd be wise. And to say something new, I say, is the trend is your friend. If the market just does not seem to want to give anything up, you're probably going to proceed. If the market's giving up some ground and we're getting down and we keep going, we have some different sources to help us on this too, that maybe we go a little bit longer on this, but at the same time, we are very cautious as a company.
At the same time, these funds, the narrative changes in a heartbeat, and all of a sudden, boom. In June, if we had been more patient and known about the fire at the LNG plant that happened after the fact, we could have hedged it somewhat lower, but you're always risking a complete reversal.
Yeah.
And just to talk about cost per minute for the people that are there. Last year, this time gas was around $4, right? Now it's sitting at around $6.80-ish.
Yeah.
So you're looking at costs being higher this winter. And that's where the market is.
Mm-hmm.
Now, another factor we haven't really talked about is cash. Because if you look today, the market's trading $6.70, $6.80, but physical gas for purchase today is trading $2 under that. And that's another strong bear indicator that we've got more downside to this market right now.
Yeah. And so like in a summary fashion, out of the people I've connected with, you've connected with, there is so much of a bearish tone here to it that the market is just completely overbought right now. But if the last 12 months have taught me anything, is logic doesn't always prevail here. And so, as you pointed out, like speculators and traders can run this thing up. And what would be kind of a poor situation and happened last winter is like, hey, we're doing good on this. We're going to keep riding this out. And then what do you know? One couple hours before the close, it runs up $1.50. That's the crap I want to avoid. And I'll use that type of wording here. And so we talked about at least getting the permission on a layered hedge, but we are very interested in probably going full in on a hedge at some point for those critical winter months. Correct?
That's right.
Okay. So to summarize it up, 50% hedge, looking at that authority over for this winter into next summer, and probably a full on, not right now to just pull a pin on this, but try to capture another lower spot or lower element as we drift in the winter for January, February, and March, maybe in December at that point.
That's right.
Okay. Well, we did it 27 minutes. If you guys have any questions, you can hit them up in the chat element here. I'm not going to just sit around and wait for people to pull up. I'm gonna see if we got any questions on this front. And of course, I think most people are really good about this when it comes to hitting up emails and so forth. But if you guys do have any other questions, like after this meeting and what have you, just pick up the phone, send an email, and be happy to have a conversation with you. You are going to get an email from us regarding this permission, so that we are not doing a fire drill with folks to, basically wait to the last moment and try to push this along here. So, yep, question came up here. When do we have to make the decision to hedge 50% or 100%? Let's just stick with the first part of that.
Well, I think, there's two ways to look at that question. One is, I think we've already explained, we're going to be looking very hard starting the second week of October at the fundamentals and market conditions and everything we see in the market on whether to hedge or not. But in terms of clients, we would like authority to do those hedges as soon as possible. Because again, we try to be predictive of what the markets do, but the markets, will swing, quite frankly. And as soon as we see indicators, we have to have that authority to act, or the market can move 50 cents or $1.50 in 30 minutes, like it did the one time.
Yeah, so I think for people that have been around us for a while, we traditionally didn't do it this way. We always did it where, hey, the market's doing this, we're on the phone, we're on an email. As we've grown a bit, it becomes, you can't react as quick anymore with this back and forth. So the idea here would be, we'll try to get sooner than later, meaning the next couple of days, permission to us to do this. Though we would probably, I can't say when we'll do it, but it's going to be in the next couple of weeks. You'll probably see some activity from an actual execution standpoint. So I hope that answers the question. Regarding the 100%, that's probably going to come at a later conversation. That's not right now.
That's right.
Yeah. So that's not right.
I mean, the fundamentals right now are extremely favorable to us.
Yes.
But as we've pointed out, weather forecasts change. Putin uses a nuke. I mean, there's so many wild cards right now that while everything fundamentally, if you just put those blinders on and say fundamentally, yeah, prices should be going down.
Yeah. Well, at the end of the day, for people that understand, I don't know, what we're doing in the commodity side, we are a fundamentally heavy company about, and what's the quote you had here? Speculators will always collapse. Speculation will always collapse in the face of fundamentals. So you got to come back to this meat and potatoes.
Yeah.
And so we're a meat and potatoes company on this sort of stuff. And that's what we're going to be our guiding star. And to your point, there are so many indications that bearish, and that this market is just overpriced. But that's logic being applied to something that has been illogical lately. So, a great question here. I love this question. I love this question because it's challenging. What is the trigger price for give November to, just keep it simple, November to March strip, which I'll pull back up here again.
Well, again, I tend to look at January, for instance, and January, the low in recent times has been 6. And if you extrapolate that turns into a D through March, probably in the 560 range. So initially that's kind of our target, but again, we're looking at, we're going to be evaluating the fundamentals day by day as we move towards the second week of October.
And well, to try to decipher this question a little bit more that's being asked, this is the trend is your friend again. If we have a pattern where this market keeps wanting to come down, every day we're watching this and it wants to come down, okay, give a little more patience to this, whatever else. But if there's a resistance here that it just cannot move itself. An example for those listening, next week, Thursday, 9:30 a.m., there's going to be a storage injection report. It's going to be rather large because of this hurricane and because of production. But if the market doesn't do anything, kind of like what just happened this Thursday, what does this start to tell people? That the market doesn't want to give it up.
I'd be shocked if that report didn't do anything. It's the report after that when you
Well-
start getting updates from NOAA on winter conditions, and you start getting professional forecasting companies updating. But the other driver of this, we don't talk, I mean, we're fundamentally based, but technical trading is a big part of this market. And when you look at that January curve, there's going to be big resistance at $6.
Yeah.
So
I'd be itchy to get a $6 handle would be wonderful, but
$6 January.
well,
yeah.
it'd be one heck of a
But that
target to
would
hit.
have a $5 handle
Yeah.
for the strip.
So I don't know if that helps answer your question. I'd want to put myself in this box too, but I'm realizing like we can't. You can set triggers. We can do this as a company. If someone said, "Hey, when our winter strip price gets to be X, we want to trigger it," we of course can do that. But I find it very difficult to hit a point right now with so much bearish indicators and what's going on to sit and go, boy, if this comes down another 20 cents, we're in on this. It's becoming difficult to say that right now. There's just such a drag down on this. So, yeah. We got one more question here. Knowing what we know now with the rise in pricing, what numbers should we look for in the future to consider a hedge over multiple years?
My theory is that, and we're seeing, tremendous amount of production. If you look at what we typically use in winter over the last 6 years, on average, we take 2.2 BCF out of the ground, and we're trending towards 3.4, 3.5. So we're going to come out of winter with 1.2, 1.3, with high level of production, and probably with demand going down, if you believe any of the recession talk, which I think we all do. So I really believe that as we exit winter and go into spring, there's a chance prices are going to tank pretty hard. So, and in fact, we've been talking about this, that we need to be prepared for all of our clients early in the year to look at those longer hedges. Because I really think, and then if you look at the LNG, you already got pipelines and producers that are queuing up to drill and pipe that gas to LNG facilities, but the LNG facilities are, as we mentioned earlier, going to take a few years to build. So I really think there's an upcoming window to hedge multiple years at cheaper prices.
I think, well, so here's the thing, and I think this is the question. I don't want to speak for the person who just asked it, but like, I think what throws anybody for a loop on this is this graph that's shared right now, which we put in our weeklies. And you just see this inversion, right? We have the prompt months, we have the winter, it's just embellished. And then you go out these successive winters and years, and it looks like hot dog. What a bargain basement price, Blake, right?
Yeah.
And so perceptively, I think I could totally get this question of like, hey, we did a 3-year deal with you guys. You said to do this. Like, why are we not capitalizing on it? However, these are record prices overall, like
That's
historically. Correct. And the only manipulation of the view that I'm seeing is because of the current months being so out of whack, it definitely makes it look attractive. But what you're saying is in the springtime, there could be this kind of inflection point where the prices could crater because of what we're seeing fundamentally again, correct?
Yeah, and about 50% of the years, the lowest price is actually in the February, March timeframe. When you have a winter that didn't fully show up and you're coming out with high production and you're bound to go to high inventory.
Roger that.
So
$6 handle. Or
$6 January.
Right.
Which translates into a 560-ish
yeah,
December through March hedge.
Mm-hmm. So right now, January is trading at what? I can tell you, it's hidden behind the screen.
680, 670,
740. It's up today.
704. Well, that's high as 704.
Yeah. So the moral of the story is we're a long way from $6. We got a long way to go.
Got about $1.
Yeah, to get there.
But we got a lot of big storage numbers coming.
Yeah.
You got cash $2 underneath, NYMEX.
Yeah. I've asked this point blank question on behalf of myself too, like we have our own point of views on this, but like without telling people what you think, but asking other folks that are devoted in the industry of commodities, in particular natural gas. And that's the marker they've hit to of just like, this belongs below that price.
Yeah.
Like period, and everything's pointing that it should go that way. So it's just like, well, got to hang on here and not it's down. If you saw the graph we showed up there before, but it's got a lot more steam to give up, it appears. So,
Well, think about this too. I mean, just last month it was trading $10.
yeah.
So when you talk about, are you risk averse?
Yeah.
It is a $6, 50% hedge appropriate when just within a month we've seen it at $10.
Yeah. I can't stand looking over your shoulder on that. And I mean, I agree. It's a couple bucks cheaper than what it was in this insane point in time like that. I mean, we didn't chase that down, which is good, but it's more forward thinking right now, and which is saying push this thing down.
Yeah.
Yeah. So, let me check my email here to see if there's any other questions. That's another great question here that you can field, Blake. I'm going to paraphrase what was said here. Will we see a return to our friends, the $4 gas and below?
Again, I think that's entirely possible. Again, I mean, production is high. Our typical average winter use is 2.2. So we should come out, unless we have the winter of all winters. But the average for the last 6 has been 2.2. We're going to come out with good storage. We're going to come out with good production and probably a shrinking economy. So, yeah.
When you go back, it's not some sort of like living out the good old days here. I'm just trying to pull up a graph here. I'm not ignoring everybody here, but I mean, you really don't have to drift too far back to find $4 gas in future winters.
That's right.
Yeah. And it's not an anomaly at that point in time. So we're just kind of like weathered this pattern over the last 8-10 months, where you're just seeing this kind of frog boiling in the water. So to go back to $4 further out, I don't think, even though it just graphically, I mean, it seems like a far ways away, it's really not that far. I mean, and it was the norm, for the longest time. So, yeah, my understanding too, I mean, one last thing just for people here, and I'm not going to belabor us for an hour on it, but is people are in the money. We're at $4. That's everything I've ever learned, was like, it was deep down to like 225, and the rig systems are getting more efficient. They're in the money, and so if gas craters again, and I put that in air quotes, at $4 again, people are still making great money that do this, right? Yeah. So it's not like we got to go, like that there's some sort of magical $5 price point where people want to do it. They're in the money with it, on that front. So, okay. I don't see any other questions. Unbelievably, we wrapped this up in like 40 minutes. So after this here, you're going to see an email, if not this afternoon, it'll come on Monday for this permission. If you're like, hey, I don't understand what the guy's asking for, we did it this summer, but just give a call, send an email, and then I'll be directing traffic on that. And it's kind of like a day-by-day approach on that front. So any last parting thoughts?
I just hope I can get back from Europe.
Oh, God, you say a prayer for those people over there. You betcha. All right, guys, thanks so much. I hope to God, someone asked us, who supplies our wardrobes, Blake? We got flannel and flannel.
This is my wife. She loves.
I bought my own
flannel.
shirt. Yeah. So yeah, this isn't like an NBC broadcast where it's like wardrobes provided by Farm and Fleet.
How'd you know?
So, all right, guys, thanks very much. I hope to dear God that we actually said something that was like affirmative and understanding, and not just nebulous and out there. Like I just can't stand that. So I hope we hit the target on that one.
So much information, it's hard to
So
get it in there.
All right, guys, thank you very much. I'll send out the recording as well, probably by Monday. Take care.
Bye.